program is brought to you by IG. Trade over 12,000 shares and ETFs, including major tech giants with extended hours on an award-winning platform. IG, where traders are made.
And the stock of the day today is Accent Group. So it's a retailer in the consumer discretionary space. It says it will close 17 underperforming glue stores. However, it's also said that earnings for FY24 will come in between $123.5 to $125.2 million, including a $14.2 million charge related to glue and those store shutdowns. But it does expect its remaining 18 stores to be profitable in 2025. What was most important, though, here is that the company said that trading conditions in the other group's outlets improved in the second half of FY24. So what does that mean? It means that people are still spending. Let's get a view on our stock of the day, Accent Group. And I might start with you, Zach Riaz.
Absolutely. Look, I think the share price shows that it came in ahead of market expectations. And I think that's one point just I want to highlight, that we've been wanting or been expecting the consumer in Australia and offshore to fall off a cliff. First with the variable rates going fixed to variable rates, et cetera, et cetera. So I think some of the reaction has also got to do with sell-side analysts getting this wrong. And I think obviously the latest update is beyond that. I think one of the things about this particular group, I haven't followed them closely, but they do have a nice mixture of brands, and that gives you some level of diversity. That also gives you, they've also got a private label business, which is still fairly underpenetrated. I mean, that's stock standard, honestly, retail business nowadays. We've got, especially this kind of model, we've got our brands that we wholesale, that we bring from offshore. Then we've got a private label brand, which gets your gross margins starting to increase. And then it's obviously a store rollout strategy. Still very cautious. Post the recent spike in share price, trading on 15 times blended forward. Retailers, 12 to 15 times is normally pretty good. I think that's normally full, but gives you a nice yield of 6%. I think there will naturally be a ceiling for these kind of stocks because we remain cautious of the consumer. But overall, I think the store rollout, and they're making decisive decisions around, closing underperforming assets and obviously brands, stores. One point I will say is that whole outdoor living brands is definitely one that's got a bit of momentum behind it.
Yeah, they've got that big Hoka shoe brand that everybody's walking around in. So would you hold this stock if you're already in it, or would you sell and take some profit?
No, I would definitely, at 15 times, like I said, versus market. I mean, market is trading at 17 times. I would be looking to take some off the table here, giving you a yield of about 6%. You can gross it up. For those that can, I would definitely still continue to maintain it if you're already in it.
Okay, thank you. What do you think, Mark?
Yeah, I tend to agree. I'd be taking advantage of the price spike to probably get out of some. I think there's better retailers around. If you're going to roll the dice with the consumer, I'd probably rather be in something like Lovisa or say Wesfarmers, but possibly not Wesfarmers at these prices at the moment. But just on the back of obviously they've got discount brands like Kmart, etc. Now, this one particularly, they've got a really good range of products. They've got the wholesale, as was covered. So. And look, you have to buy shoes. Like it's bordering on consumer staple, to be honest. But yeah, I do like the fact that they've gotten ahead of this thing and just closed 17 underperforming stores. You love management generally that will make those hard decisions because it's pretending that everything's okay and then having a much larger problem down the road is never good. So we sort of saw a similar thing with Fortescue today. Obviously, shutting down the hydrogen, but and they
I've never heard a link being made between retail and Fortescue before, but you go.
They're making a hard choice, basically, rather than just piling more and more money into it. So yeah, hold if you've got it, I suppose. I'd be probably taking some off the table here. I think we've got earnings season coming up. There'll be better if you're in it for dividend. There might be better opportunities for divvies.
I'll just make one point. What Mark just said, there are better options. Just keep an eye on JB Hi-Fi, and let me make a link to Apple. TCMC is about to report their results. Apple's just announced their AI, and if you actually chart the share price of JB Hi-Fi with Apple, there's a big correlation because Apple technology, they come to JB Hi-Fi, the best footprint, they get it out there, and if Apple is going to start coming through this upgrade cycle with this much anticipated AI, some guys like Mike said, guys with genuine competitive advantage in the retail space. Watch out for that. I think JB Hi-Fi is worth looking at.
So we've got that on the list of watches from our guests in studio today. So that is the stock of the day. Be back in a tick.
This program was brought to you by IG, Australia's #1 CFD provider. Trade over 17,000 markets with extended hours on key US shares and competitive spreads. All on an award-winning platform. IG, where traders are made.